Hello, everyone who is already coming in. We're starting the webinar on connecting climate protection and how this is also beneficial for the economy and for jobs. In a few minutes, we just wait for more attendees to come in, but looking forward to this and discussing with you about this new study that we commissioned. So we wait for 2 more minutes and see how many people come in, and then we start. For hello to everyone who is already there. It will be interesting, so I hope you can wait for the 2 more minutes before we start. Okay, hello everyone. Very welcome to this webinar on the 2030 climate target in the European Union. And the question, how high should it be? And I think it's very topical because we are currently discussing it on the European level between the decision makers. And in this debate, we have commissioned a study to check what would be the outcome of a 60% CO2 emission reduction target for 2030, as the European Parliament asks for it. And I think we will see that it is really interesting what the outcome actually is. It is beneficial for jobs and for the economy. We want to discuss this today with Unada Chupricha. She is the principal economic modeler at Camebridge Econometrics. And Cambridge Econometrics is the institute that did actually the study. And we have Terhi Lehtonen. She is the state secretary in Finland in the Ministry of the Environment and also part of the negotiation team. And I think they are in Finland having a great example of how to really make progress on the climate protection, and that is also beneficial for the economy. And we have Bas Eickhout, who was the Spitzenkandidat for the European Greens, so the leading candidate in the last election for the Greens in all over Europe. I think he also won the Nobel Prize once, so at least a little bit, because he was part of the scientific team of the IPCC. So he is really a climate crack. And he will also explain a little bit where we are on the European level with getting the investment into the climate protection right. I'm Michael Bloss, member of the European Parliament and negotiating for the Greens on the climate law, and so also on the 2030 climate target. So this webinar is recorded. So you will be able to also watch it and send it to your friends later on. But it also means that if you raise your hand and want to ask a question, we can take you actually and let you ask a question, but this will then also be recorded and will be put on the internet. As you see, there is a question and answer field down at the webinar, so you can ask questions there. You can raise your hand and ask a question orally later on. So we will have some input from all of us presenters, and then we will go into a debate, and there's the possibility to ask questions. So very much looking forward to this interesting findings. And now I want to give the floor to Unada for presenting us the study on what we found out, what would 60% less CO2 emissions by 2030 mean. So the floor is yours, and thanks a lot for this great study.
Thank you, and thank you very much for introducing myself. I'm Yunada, and I'm really pleased to be here today. Can I just ask for you to confirm that you can see my screen okay?
We can see it. Okay, thank you.
Brilliant. Great. So yes, so I'm Yunada, and I work in a company called Camebridge Econometrics, working at this large-scale economic model. So we were approached by Mr. Bloss' office back in November to ask questions about the 60% greenhouse gas reduction target, whether it's possible and what would be the impact of that. So without further ado, yeah, the key question that we were asked really, whether it was possible, because at the time we were looking at the 55% target. So, you know, whether the 60% target is possible, and if we do get to 60% target, what would be the key policy element that lead to us achieving that? And most importantly, what would be the economic and employment effect? Because this transition is quite drastic, and at the moment, you know, without running through some sort of analysis, we don't know that. So these are the questions that we're trying to answer, study. I'm just going to quickly go through the model that we use. Obviously, I don't have a lot of time here, so I'm just going to quickly give you an overview. The model is used is called E3ME. E3 is short for economy, energy, and environment, so it's all very well connected. It's a global model with the 61 world region, and each member state is part of that regions. It has a detailed sectoral disaggregation, so we can clearly identify the winner and losers from the transition. At the heart of it is technology. So technology diffusion is key to our low carbon transition, and it is endogenous within the model. And you can see that many of the policy instrument we put in is aimed at basically encouraging take-up of low carbon technologies. The key distinction of the model is in its theory. So it's a post-Keynesian type of model, and what this means in sort of a basic term is that it doesn't assume optimization, and that's mean that when we plug in additional policy, the unutilized resources or labor can be made utilized and create additional jobs and investment. So this is quite different to many of the macroeconomic model out there, which look at the transition that come with cost. So it's additional cost to the society, whereas for us, we're looking at the opportunity really, that the investment that can bring about from the low carbon transition. Okay, so for this study, we have 3 different scenarios. So one with the baseline. So this study was done back in November. So we include COVID impact back then. So, you know, things has moved on really quickly. But yeah, so the impact of COVID is back in October, and then the baseline include current policies up until that point, really. And then we're looking at the 55% emission reduction target as one set of scenarios, and the 60% target being the third scenarios. The target that we look at in the modeling here exclude land use emissions, so it's purely from the energy consumption emission. And in all of our revenue, we assume revenue neutrality, which is quite important. I will talk a bit more in the next slide. In order to achieve the 60% target and 55%, we identified key policies. As you can see, it's cover a wide range of sector, ranging from ETS and carbon tax. But the 2 key policies that we find as the most effective are the coal phase out regulation and the ban in petrol and diesel sales by 2030. And The key point about these policies that we try to model are that they are complementing each other. So you could have energy efficiency that reduce energy consumption, and that would help with the carbon tax, so the amount of taxes that they have to be paid. But also it helps to generate revenue. So the ETS and the carbon tax can generate revenue to fund for other low carbon policy. For example, it can be used to reduce costs, or it can be used to be fund for the renewable subsidy or fund for investment in energy efficiency investment. So our revenue neutrality's assumption remain, and the policies are there to help support each other and also provide funding for our other policies. And the result you can see here, this is the emission trajectories. So in the baseline, as I say, we already have a small impact of COVID in 2020, and the current policies up until that point is already quite strong. We know that solar and wind costs are already coming down, so the take-up of wind and solars are already there in the baseline. The 55% target is the blue line, and the 60% target is in the green line here. The kink in the last year in the 60% target is because of the remaining coal power plants being shut down. So we see a sharp reduction in that particular year. And in terms of where the reduction come from, so it's reflect mainly the policy we put in. So all the sectors will contribute to this 60% and the 55% target. But in the 60%, because we introduced the reduction, the regulation and coal power plant, and for transport, the ban of petrol and diesel sales, we can see the bigger contribution are coming from the power sector and the transport, in the sector that we know that the technologies are there already, and the transition, the additional ambition is possible. Within the power sector, you can see clearly that from out reductions, regulation of coal, it's promoting more take-up of renewable, mainly solar and wind. Nuclear, we also introduced the sort of the national planned phase out of nuclear in the 60% target. So you see the share of nuclear is smaller. But otherwise, by making nuclear smaller and regulating coal, we're making room for renewable to really take off. And you can see that in the 60% target, we already heading towards kind of like 100% renewable, if you like, in the power sector. And this is the key for electrification in all other sector, because it can be. Moving on to the economic impacts. So this is clearly, you can see that the higher ambition comes with additional economic benefit. And in this case, we're looking at GDP impacts here. It's quite uneven. You can see that it's not like a straight line, because it just reflects the policies where the kind of like the phase out come in, where the additional investment had to take place and so on. But the key point here is that the higher ambition can actually create economic stimulus for the EU 27. And the way it comes about is mainly through the investment that need to take place for the low carbon investment, as I say, is funded through the policies. But cost aside, it's actually the multiplier effect of these investments generated higher economic activity throughout the EU economy. Not only the investment, but there are two other factors that contribute to this growth. First of all is the consumer spending. Because the policy that we decide subsidize renewable, the cost of energy also go down. The energy efficiency investment mean that there will be energy savings throughout. So basically we'll have more money to spend on other. consumer also benefit from lower energy costs. There's also a small benefit from revenue recycling. So we assume that the revenue that collected from the carbon tax and ETS after it has been deducted for investment costs for energy efficiency, after it has been deducted for subsidies and so on, there's some small revenues left that we can be used to reduce income tax and social security contribution, and so consumer would benefit that way. Thirdly, and most related to the import of fossil fuels, and we know that the EU is the net importer of energy. So by moving away from energy, we actually see improving balance of payment, and therefore those money that would have been spent otherwise on imports of energy product can be now spent within the EU economy. So those are the three key kind of like mechanism here why GDP impact has increased within the EU. The impacts of jobs usually follow GDP impacts, although it's not as high as the GDP increase, and that's because of the productivity gains. But we also know that jobs, there is a constraint on how much available jobs are there. Here we see about 1.1 million jobs, and in the aftermath of the COVID pandemic, I think this level of jobs that will definitely be kind of like those who are unemployed who can be made employed in the transition. And yes, and what we find is that there will be a jobs increase, and the jobs increase are in the sector, for example, the construction worker who maybe have to insulate homes, in the renewable sector, so manufacturer that need to produce solar panel, those car manufacturer that need to produce new type of engine and so on. So the transition can create jobs, and that's quite key in in moving, reducing unemployment, and perhaps help address these labor market issues. We acknowledge that these jobs will require new skills. So perhaps until in the aftermath of COVID, I think the key policies should be to reskill our labor force in order to help with the transition, because if it's coming, we do need people to know how to operate the renewable technologies and so on. So that's the impact on jobs. And the key message that I have here is that I hope we answered the three key questions of this study. So the 60% reduction in greenhouse gases is definitely possible. And the key policies that we can contribute to that is the regulation in coal phase out and EV deployment. The key other message is that it's going to be quite expensive to do so. So in the peak year where the transition happened, there could be up to about 87 billion of the revenue gap that need to come from somewhere. So we need strong policy support from policymaker. However, once the policy and funding are there, then the investment can really take place, and these investment will create jobs and GDP benefit. And as I say, longer term, this transition will reduce our import dependency of fossil fuels. We haven't talked so much about impact among member states, but in our analysis, all member states will benefit from this transition. Obviously, there are differences between member states. Those who are energy producer or have a large extraction industry would not benefit as much, but the key message is that all will benefit. And also similarly throughout income groups, so from lowest income quintile to the highest income groups, we all benefit from this transition, mainly from the energy saving and lower electricity price. And at sector level, the clear loser would be the distribution, the gas distribution, so energy related provider. Electricity is different because obviously there will be demand for electricity, and the positive impact are in the sector that produce and install new equipment such as engineering and construction. That's the end of my presentation. Thank you.
Thank you very much, Renata. That's, I think, a really interesting study, and then also really interesting what you told us. Also, the main message. I just want to stress that again, we are currently negotiating about the question how much CO2 reduction we want to have in 2030. And the next negotiation round is actually in 1 week. And we need to be very fast in getting to a result. The Parliament says we want to have 60% emission reduction, and the Council and the Commission says only 55% net. That could even be even less than 55% in actual reduction. And one of the arguments is always that we are in a crisis, and in the crisis we have to make sure that we cannot support the cause of the climate protection as much, because we have to also support the other parts of the economy. And I think it's so wonderful that your study shows actually that it's a little bit, it's turned around. If we go now in for more climate protection, even more with the 60%, that's in these times of COVID crisis beneficial to the economy, and it will create additional jobs. And this is, I think, what we need right now, because also a lot of people lost their jobs. And if you see also what, I mean, we did not discuss so much, we said, okay, there's two main policies, which is the coal phase out by 2030. And for Poland, there is even a little bit more time, and the end of the combustion engine. And we assumed, or the price level that you assume for the ETS, so for the cost of CO2 emission, is actually quite, how do you say, well, it's not as high. Currently, we're already at 40 euros, around 40 euros. Your baseline, or your 55 was 42 in 2030, and around 50 euros for the 60% in 2030. So I guess we will be much higher than that. So that will drive out the coal in any case, I believe. And then if you look into actually what it means for, as you said, for the different countries, I just checked before what it means for Finland and the Netherlands and for Germany. And for Finland, it means 0.8% more jobs compared with 55. For the Netherlands, it means 0.3% more jobs. For Germany, 0.7% more jobs. And for growth, for the Netherlands, it means 1.6% more growth percentage points. And for Finland, 0.5 percentage points more growth. So that's, I think, a very good message we need to get across. Also to the Commission and to everyone, because as it's clear that it would be beneficial for everyone to do now more for the climate. Of course, we need to do that fast. So the model is from 2021 onwards, and we hope that we get the policies kicking in very, very early, because the earlier we start, the better it is for the climate and for the economy. And I think that's just the message also I want to bring across. And as Greens, of course, we are always a little bit skeptical of growth, and I think that's okay. But I think currently in the negotiations, it's important, and in the crisis, it's important that we are sending this message out. And also it is important to understand that if we want to have a fast and early transition of the economy towards zero carbon emission, then we need to invest now, and that of course means growth. So I'm really looking forward to actually discuss the findings of this study with, for instance, the people in the Commission, because I think it should have some impact to change this way of thinking. But I wanted to give the floor to Terhi Lehtonen, and as I think the Finnish government, actually they already have this course and this idea that we are going to do a lot for the climate, and that's also good for the economy. So maybe you could reflect a little bit on what you just heard, and also describe what you are doing in Finland in this regard already. Thank you.
Thank you, Miha, and thank you for the invitation and the opportunity to comment this very interesting study and bring some reflections from Finland. First of all, I wanted to stress that I welcome especially that the study looks at the 60% reductions without LULUCF, And I think we all agree that while it's very important that our policies, our agricultural policy, our energy policy, that they ensure the maintenance and enhancement of our land sector carbon sink, the most urgent action to take is the reduction and elimination of fossil carbon emissions. And it's not an easy feat. Our economies were built based on fossil fuels. Fossil fuels are deeply embedded in our societies, in buildings, in transport, energy systems, and the transformations are considerable. And whereas the developing economies will hopefully leapfrog to a different energy system and hopefully smarter resource use as they grow, Finland wants to show that a transition from a relatively high greenhouse gas economy to a climate neutral and eventually negative emissions is possible and can be done by 2035 in a manner that is fair and leaves no one behind, and with a stronger economy as a result. But first, some few reflections and messages to take home from the study. So the additional annual investments needed to achieve a higher reduction target, 60%, are substantial, and the total investments could be over 3% higher than compared to the baseline. And then this investment drives the higher GDP in the EU by 1.8%, as was mentioned, and higher employment. And we're talking about more than 1 million new jobs. The additional investments required are in large part due to additional renewable investments required to phase out coal. And as you already mentioned, the positive employment effects concern all 27 member states, are higher in the 60% for all member states. So the really good news is, like so well put by Unada before, is that we can do a higher target, and the technologies are already there. And perhaps some technical or comments on the design of the study, but I understand that you couldn't model all possible eventualities, but in real life, of course, the carbon price, you assume that the carbon price for ETS and non-ETS is the same. I think in our experience is that the non-ETS requires a much higher carbon price. You also, for simplicity, assume that the revenues would be allocated to the transition, but we also know that there's a lot of other government needs and demand for revenue, so that could be of course challenge, and it could also be that investing it into R&D could also be a good climate for the climate transition. Another question that I had maybe was on this additional consumption, which was one of the results of saving on energy cost and increasing employment, and of course, if that consumption is leading, did you experience any higher emissions due to that consumption? But just to come back, Miha, on a few words about Finland. Now, our climate neutrality by 2035 goal was set on the basis of climate science panel assessment of what is consistent with our commitment under the Paris Agreement to pursue limiting warming to 1.5 degrees. And Finland is a large country with a cold climate, a sparse population, and long transport distances, and a high share of energy-intensive industry. Our per capita greenhouse gas emissions are among the highest in the EU. So we thought, if Finland can be climate neutral by 2035, other countries should be able to do so as well. We have already many policies in place that will deliver greenhouse gas reductions, for example, a ban on coal by 2029 and targets to halve transport emissions by 2030. And while our government was not able to outline all the policies necessary to achieve the target at the outset, we are currently working on the strategies and on the sets of policies and measures that will lead to climate neutrality by 2035 in a manner that is cost effective and socially and regionally fair. And we find similar results in terms of employment. We're just in the process of putting together the impact assessments for the 2030 and 2040. So that I can't quote you now the economic, the investment and the employment of our situation, but we should have them in the coming months. We already put indicative emission reduction targets for all of those reforms, and we are about to take stock this spring in our mid-government term on where we are, and we need to still adjust and have new decisions. We will also put this into our law, so the climate neutrality target, and we will at the same time set domestic 2030 and 2040 emission reduction targets. And it's interesting that our climate science panel has recommended to us a target of 60% for 2030, and that would be for Finland, then the ETS and effort sharing sectors combined. The government has also successfully worked together with industries on carbon neutrality roadmaps, and all the key sectors, actually more sectors that we had outlined and thought that were required, developed their own roadmaps to map out the emission reduction potential and the necessary enabling conditions, and the clean technologies potential for a positive carbon handprint across global value chain. And in fact, when I said that we had put carbon budgets to different reforms, we had also, as a government, foreseen some reductions that would be assigned to these roadmaps. And the reality was that the industry roadmaps came up with more emission reduction potential than we had thought was possible. Now, it's clear that this is potential. It's not yet a commitment to deliver all of that. It requires the right conditions, most crucially, a sufficient carbon price and measures to level the playing field in respect of this carbon constraint. So this requires tightening and strengthening the EU emissions trading scheme, as according to our analysis, a big share of the emission reductions we need to achieve the 2030 in the 2030 perspective should come from the sectors under the EU emissions trading, similar to what was your analysis here. And we had to conclude. So for us, the departing point is on the basis of what is necessary to maintain global warming to less than 1.5 degrees. But accelerating the path to climate neutrality is a climate strategy, but as this new study also proves, it is also an investment strategy. It's an investment strategy that will improve our societies and increase the well-being of European citizens. Thank you.
Great, thank you very much. And that's, I think, the word for Bloss. It is an investment strategy. And now from Europe, there is a lot of investment coming or should be coming. So maybe it would be interesting to hear your thoughts on the study and on what is actually happening in terms of investment right now.
Yeah, thanks a lot, Misha. And first of all, thanks a lot, Unada, for the very interesting study, which indeed once more is making the case economically, right? I mean, you mentioned the IPCC report, Misha. By the way, this Nobel Prize, I was only contributing author, so it's a very tiny bit, but okay, I'll take it. But the scientists are writing for a very long while already, right? We need to do something about it. We can do something about it. And economically, it is also a viable option. It's even a must to do it, also economically speaking. So the message basically coming from the science is very long time there. I think one of the biggest challenges that we are having is indeed, can we as Europe get to an investment strategy? And that is now, I think, the most crucial part that we need to address, because Europe has been very well in designing policies. But then if you don't have an investment strategy that is really driving the investments in the right direction, then of course only having this policy framework is not sufficient. And I will go a bit into how I think what are the key elements for an investment strategy. And I think Terry, I mean State Secretary Lehtonen already mentioned some elements that Finland is using, and I think that's showing also that Finland is thinking of also developing an investment strategy next to the framework we're putting in place for policies. So first of all, what you need to do is, of course, for investors, because we all know capital is there enough, right? There is no shortage of capital, but we need to use it in the proper way. Well, for that, you need to do a couple of things. First of all, there needs to be a clear business case for investors. And that is basically getting the price right. So that is putting a price on pollution. And there, of course, the European Union has a pretty good instrument, which is called ETS. But then, of course, we need to make sure that the ETS revision leads to a sufficient carbon price. And that has been a problem for a very long while. We have been around €5 per ton CO2 for a very long while. Now, finally, the last couple of years, we are increasing. It's now around €40 per ton CO2, but that's basically only the start of the levels where we need to be if you are talking about putting the right price on pollution of carbon. So the tool is there, but the strengthening of the tool is needed, certainly the strengthening of the carbon price. And I'm sure that in the European Union and in the European Parliament, you, Misha, can have a lot of fun with that once the ETS proposal will be out there in June. But that's only one small part of the picture that we need. Secondly, for investors, they need clarity and certainty on, okay, there is now a price, so we are having a business case, but where to go to? Then you need clarity from governments. And this boils down to clear transition plans, or as Terry was talking about it, and these roadmaps, sectoral roadmaps, where to go to. Provide this certainty, and that is very crucial for investors to know where the money should go to. And I think here Europe, until now, has not delivered sufficient clarity. It is great to hear that Finland is doing that now with their sectors, but basically this should be done for all sectors and preferably European-wide, in order to, for investors, really know that this is the direction of entire Europe is going. That would tremendously help. For these clear transition pathways, you don't only need to know what is the longer term goal, but also, do we know for sure that there will be a demand for the new products? And this is, of course, where Europe has been quite weak. We have been good in addressing all kind of supply-driven measures, but on the demand side, will there be a demand for the different products? There we need to strengthen our policies as well. And that basically boils down to an industrial policy. And if you look at, for example, the communications that the European Commission has done on industrial policy until now, it has been very weak on incorporating the Green Deal in an industrial policy. And I think that is one of the problems that we still need to address. Thirdly, what is then important is that the investors also need to know where lies the risk of current investments. In other way, how can we make sure that the risk being taken in the current investments are being diverted? And this, of course, boils down to incorporating better risk assessments of climate damage into the analysis of national supervisors of the national banks, for example. Well, there, the European Union has only taken its first steps on sustainable finance, where a taxonomy is provided for green investment, but still what is totally lacking is, of course, a taxonomy on the non-sustainable investments. And that is a crucial step to be taken. I just want to throw in one number because it's quite telling. And it's an analysis of the Dutch National Bank. And they analyzed that the Dutch financial institutions, so I'm only talking about the Dutch financial institutions, they have an over €500 billion exposure to companies who are highly dependent on well-functioning ecosystems. So this shows that if these ecosystems do not function well enough anymore, the exposure to that will be a high risk, will be at risk. And that's for only the Dutch institutions already over €500 billion. So that shows how we are still not providing the money in the right direction. Last point, and that is, of course, if we have all that in place, of course, then also the European Union itself needs to put public investments in the right direction, because the big money is at the private capital, but of course, publicly, you need to set the right standards and the right example. And there, indeed, it is interesting to note that the entire Corona crisis has finally gained possibilities for a European investment plan, and this has been called this RRF, the Recovery and Resilience Funds. it was not super welcomed by some of the countries that are also around this table. But fortunately enough, it was in the end agreed upon, and that is a good start. But now we need to make sure that this money and these national recovery plans are really going into green investments and in a real green transition. The target has been set for the funds that 37% should go to greening. But now the big battle will be, and this is a responsibility, well, of course, of the national member states, but certainly of the European Commission, when they are going to judge these national plans, will it really be a real 37% of greening, or is it just a bit, you know, business as usual and tickling at the edges? And this is, of course, what we are now. The policies have been approved on that last part, but now we need to implement it, and their national member states are crucial, and certainly also the European Commission in tough assessments. So if we have all that in place, then we can talk about an investment strategy, and then I think we can reap the potential that the study has showed of today, and that's the big assignment for the European Union to come. Thanks a lot.
Thank you very much, Bas. So now we opened a little bit the whole debate from the climate law debate, from the national perspective and the investment environment. You can ask us questions in different ways. You can raise your hand. You can put questions in the question and answering tool. And we have around 20 minutes to answer the question. So maybe we start first with the ones in the tool, and then we already have two people who raised their hand, and we will ask them then to unmute themselves, and then we can hear your question. So the first one is from Kai, and he asks to Bas and to me, do we argue for higher investment with higher revenues from increased carbon pricing? Does it mean vice versa, like investments will have to increase when revenues are declining? The second one is from Andreas, but he also raised his hand, so maybe I can leave this question maybe for a live question. Do you see any chance to raise the EU greenhouse gas target to 60 or 65%? And the last question before then, well, then we answer and then I take people, is do you in general refer to greenhouse gas or to CO2 emissions? Okay, so Bas, do you want to start? And then we Unana, then I can go, and Terry, and then we go for the ones who raised their hand.
Yeah, I think I'll focus on the question that Kai raised on the revenues. I hope on some of the elements of the investment needs I already addressed that, because the question of Kai was earlier on there. One of the ways, one of the means to create some of the investment money is, of course, through the revenues of ETS. So absolutely, there is a link. But I think that we should not make the mistake to think that ETS revenues will solve it. I hope I explained it's really, we are talking about a massive investment program for the European Union that is transitioning our economy to a new economy with a huge potential for new jobs, but it requires really huge investments. Let's be honest about that. Of course, some politicians will frame that as costs, but it's really an investment, and investments are being done every day. I mean, we need to stress that, because sometimes politicians talk about investment as the same as a cost. That's of course not true. It's an investment which every day is happening. Just on imports of oil, we are basically importing oil and gas every day, and that's throwing away billions of euros every year. So investments are taken there. We need to guide it into the right direction. Many tools need to be in place for that, and one of the tools could be the revenues. But I think that that is only a small part, also because the revenues need to be used for also making sure that the differences within the European Union are being addressed in order to make this a socially fair transition. That is also very crucial. So in that sense, there is a clear link with ETS revenues, but I would not put it one-on-one as in the question by Kai.
Great. Maybe Unada on the greenhouse gas emission and CO2.
Yeah, so in the modeling, we only captured CO2 emission, and we make sure that the reduction is met. The 60% is come from the CO2. Yeah, so you're right. So, but then it's fit with the overall kind of like greenhouse gas emission reduction target. So we sort of assume that all the other greenhouse gases are falling about the same. But yeah, because the modeling capability, we cannot capture that. Just to supplement on the roles of the carbon pricing. So for the modeling perspective, carbon pricing alone is not enough. It does act as a signaling for investor. So they know that actually, you know, it added cost to coal power plants, to the use of oil and gas and so on. But once that signaling effects are there, it's then encourage the take up of renewable technology. And you must remember that the technology follow the S-curve path. So the more people are taking up this technology, the cheaper it will be, because the learning effect, the spillover effect. And we must say that in the modeling, we actually didn't look at rest of the world action at all. In reality, with the China, Korea, Japan all announcing net zero, and possibly the US, this technology will be, you know, already very attractive to investor. So even without policy, the cost of these renewables should come down already and act as a signaling for investor to switch away from fossil fuel. Thank you.
Okay, Terry, do you want to also go first? Maybe there are some questions also on the climate law, or like maybe also on the question on the carbon pricing. How do you see that? Then I take the rest of the questions on lobbyism and so on.
Thank you, Miha. I'm not able to keep the screens open, so maybe you'll need to read some of the questions. But I saw the question on whether there is any chance to raise the EU greenhouse gas target to 60 or 65. Well, I think it's a good question, but I think we should all recognize that it's in any case, the 55 is a minimum. And until now, EU has also always overachieved or actually been able to put in place policies that drive more emission reductions. So we should aim for that now too. This is also what we have been, my minister has been saying that with all the policies that the Commission puts forward now this summer, they should all be geared to go further and not just the minimally achieve 55 but to go beyond. And I stressed this earlier that your study has the great approach of not looking at the LULUCF sector for this 2030 additional greenhouse gas reduction effort. And I think that there as well, we'll need to have policies in place that encourage the capture of carbon inland and encourage the reduction of real emissions in the land use sector. And those should be above, in my view and in my government's view. But so there's still a lot of space in the play of the policies that will be designed and will be in the hands of the European Parliament and the Council. So I think we don't need to focus now at whether really right now we change the number, but we have to work towards a higher carbon reduction for 2030 all along. So I think I'll leave it at that. Thank you.
Thank you, Terry. Yes, and I think the question is of course important. We, as the Greens, our position is we want to have 65% emission reduction as the Greens in the Parliament, and that's still our position. We did now the study and model it on the 60% because currently this is the debate we are having around the climate law and around the target, and we wanted to debunk the argument that 60% would not be possible and would be bad for the economy. And this is, I think, exactly what the study is doing and what we were able to show. But of course, the 65% is something that we want, but you probably know the Parliament decided to go for a 60% target, and the Council for a lower target, 55%. And this is currently the debate we are having. And of course, that's what we hope, that we will be able to move it towards the 60% target in some way. And I hope that in the future we will be seeing that we can be even more ambitious because it's beneficial. Then there was the question of the on the climate neutrality for the member state level, but that's also in the climate law, that by 2050 the European Union should be as a whole climate neutral. That's what the member states want, and the parliament says, and also each member state should be. So there are also lots of debates and questions. I think there's many countries like Finland, they want to be climate neutral even earlier, or Germany says until now 2050, but others like Poland, they say we don't want to have this on the member state level. This is the debate we are having, and I think also the member states amongst themselves are having this debate, because I think a majority of the member states, they anyway go for 2050 already, or even before 2050 for their own national target. We have a question on lobbying and subsidies, and how much like lobbying on the European level is an obstacle to 60%. Well, it depends. Yeah, this is of course always every lobby group says that they need their interests to be met, and I think when we look into what the study also says is, of course, there are also losers. No, I mean that's clear that when we want to move away from the fossil economy, then the fossil, the refineries, they will not maybe make that much of a profit in the future, because of course we don't want to refine crude oil, but maybe there are also possibilities for them in a different way. So of course lobbying is an issue always. I'm not sure how much it's actually taking place then on the member state or on the commission level, because we don't see that so much. But I think, and this is also, there's also positive lobbying, and especially the younger generations, the Fridays for Future, they actually also made a lot of noise around it. And I'm not sure you can hear the noise in the back of mine. There's also a younger generation making some noise. Yeah, so this is happening. And on the subsidies, we as the parliament have said that we want to phase out fossil subsidies by 2025. Of course, this is also something that we debate with the council, and currently the member states basically tell us that this is outside of the scope of the climate law. We should discuss it at a different place, but yeah, that's all part of the negotiation process. So you see that it actually makes sense to still engage into the climate law, because there's many important things on the table, and it's not a done deal yet, and we can really achieve something. So now we only have 7 minutes left, and we have 3 people. So I ask you to be quick in asking your questions. It's David, Oras, and Andreas. I will just take you in this order, and then we do a last round, and then we finish this up. So David, I allow you to talk now. So now you can unmute yourself. Yes, your short question.
Yeah, so I have 2 short questions. The first one would be from this economic study model, can we assume that a even higher target than -60% will also lead to more economic growth and provide more jobs? And the second question would be, are there any studies or work on the impact after 2030? Because I mean, from 2030 on, we have 20 years to reduce 40% more going of a -60% target. And are there any numbers on the impact of such a higher target then?
Thank you, David. Oras.
Thank you very much for a very interesting study and event. To me, it would seem that the conclusions from this study are broadly in line with some of the previous studies that have come out on the same topic, such as the one by Climact. I just wonder, Unada, if you can talk to possible differences or divergences between these studies. Was there something in your study that is in contrast to some of the previous studies looking at the 2030 emission targets?
Thank you very much, Oras, also for the time. Now, Andreas.
Thank you for the event and welcome to the world of fathership. I've got two questions. I mean, we trade unions want to turn words into action, and a little remark, we want you to talk with workers, not about workers. I think that's very important. Question one, net gain, correct? But how do you do that reskilling? Have you got any ideas how to reskill an assembly line worker in the automotive sector into a construction worker or somebody who installs solar panels? Because that's the question: how you do it? How do you go about these individuals and workers that are confronted with the transition? Second question, very quick: fiscal policy response of the Commission. It was mentioned a golden and green rule. I found that very interesting. Bas, you were there. What do you think? How are the chances to get such a thing for investments into the Green Deal? Thank you.
Great. Thank you, Andreas. So maybe we can also just do the round as before. Maybe Bas, Unada, Terry, and then I will say bye-bye to you. So yeah, thanks a lot for the great question, Bas.
Yeah, thanks a lot. I think I'll mainly focus on Andreas because the other questions were all for Unada, at least how I got it. So brace yourself, Unada. Maybe on Andreas' question. First of all, on the reskilling, that is, of course, one of the biggest challenges. It sounds nice as a concept, but I think I would now exactly make the mistake that you were saying, don't do that, don't talk about, but talk with. I think this is exactly one of those elements where we need to sit down, certainly with the people on, because the general concept, we know what it means, but this is going to be totally specific per sector and per country, also looking at how the transition will look like. And I don't know whether Terry has some experience in Finland, but of course this is in every country different, and it will have an impact. And I think that we need to think, and there will be no one golden solution there, and certainly not indeed if as politicians only talk about instead of with. And I think on this element it's totally crucial. On the other elements, we are now just starting on a debate about the Stability and Growth Pact, right? So the fiscal space, the fiscal rules from the European Union. I think what I see is a shift in the European Commission, that they do realize that the current rules are not counter-cyclical, which of course, especially in poor economic times, is a big problem. So we need to adjust those rules. And I think even the more hawkish people in the Commission realize that some of these rules need to be changed in order to create more space in investments, certainly also in more economic difficult times, because then public investments, relatively speaking, are even becoming more important, because in more difficult times, the private investors will be more reluctant. So then room for public investment is even more important. There is now that even the more hawkish people in the European Commission are saying, well, and some of these investments should indeed be green investments. So should we take that out of the fiscal rules, or should we do more spreading over time of these fiscal rules? I think those are really possibilities. But in the end, this boils down to member states. And I'm happy to have a very German audience, but this is going to be so crucial. Is this debate going to change something in Germany? That is going to be very, very important for the Green Deal. And unfortunately, until now, that debate is not big enough in Germany. I've seen a very good op-ed of Thomas Habeck with the trade unions on investment and on the fiscal rules, which was really good. But well, this really needs a proper debate, also in my country. But to be very honest, we will follow if Germany changes.
Okay, let me answer the questions to David first. So going from 60 to, say, higher ambition is then become more of a technology problem, I think, because in our study here, we kind of like tackle and tapping into the renewable technology that's already there for the power sector and shifting to EVs. So the additional bit will become a bit harder, if you like, because for all other sector, the technology are still in kind of like in a very early stage. So we would need quite an ambition, kind of like an R&D support for the sector, for the new technology to take place, and for the funding, because you can always plug in a higher investment into the model and you get the positive impact on GDP, but these investments do not make sense if the technology aren't there and it's really expensive. So we do need support for these new technology to establish. And the policy support as well, because there will be funding needed for this expensive technology to become mainstream. So yeah, so in terms of modeling, yeah, if the technology are there, then definitely like additional investment will create job, and these investment actually benefit in the longer term in terms of reducing fossil fuel dependency and reducing kind of like energy bills to many households and industry. So impact after 2030 is, even if nothing else happening after 2030, so our study cutoff is 2030, the investment will stop, but the longer term benefit will continue. So the improvement in the trade balance, the technology take up will continue to take place because we already kind of like kickstart, if you like, the technology adoption. And yeah, so we'll benefit from lower energy bills. But to get to the 2050 climate neutrality, then we're gonna have to keep kind of like plugging in these investment to be more ambitious. So yeah, one would expect kind of like a continuous of that growth. And I agreed about the skills. These are net job increase. We will need to make sure that the transition, if you like, can take place because we have enough labor that can work on this transition and the skill appropriated to that transition. Then moving on to the question from RS. So this study basically is our own kind of like, we're plugging in a lot of policies. It's our own set of policy, if you like, that we use. The E3ME model also was used for the impact assessment for the European Commission 55% target. And the key difference of our model, I believe, is that this non-optimization approach. So we treat investment as a stimulus that can be tapped in for unused resources, and unemployed people can be made employed and so on. Whereas in our other model, often see this as cost, and cost mean negative, really, like the negative impact on GDP. And you clearly see that in the impact assessment, where they use an optimization model alongside the E3ME, or most of the IPCC model that we use for the analysis optimization. And so they identified these costs associated with the climate transition, whereas for us, it's the investment that drives this growth.
Okay, maybe you want to also comment a little bit on the skills agenda, maybe what is something happening there in Finland.
Thank you, Miha. That's exactly what I wanted to come back to. First, I wanted to return to what Bloss was already saying about the recovery funds, the EU funds, and the climate investment. The EU agreement was that minimum 37% should go to actively for climate investments, and in Finland we've decided to do that at 50%. And I must say that it's great that we have very clear criteria, and that there is a clear investment guidance, and what counts for 100% climate. That helps us nationally to straighten and we lose some debates that might otherwise take some time, put it that way. But I see also so we see a space in the RRF program that we have for skills development. I think it was great that you highlighted this in the study as well. So we see that there is a question whether we do lifelong learning type of so reskilling, but we also see some space and need for new skills and new so for new employment and new studies to be in this environmental field. I think we need a lot of skilled people for the circular economy, for greenhouse gas reductions. We need more engineers or skilled people there. But again, then the Just Transition Fund is another EU instrument that can help in this reskilling. We think that there's a lot of potential for financing there, and here we are also hoping to be able to start a discussion in Finland and do an analysis with the labor union partners to do an analysis in Finland, where in Finland what types of skills are needed, and and hopefully we can start this soon, and then tap into also the Just Transition Funds. Thank you.
Thank you. Yes, and I can only say, Andreas, I'm happily going with you to the workers in Stuttgart at the Mercedes-Benz factories. I would be really delighted to organize something there and discuss, because then I think, yeah, as you said, this is the best way to actually come to some common position. And I can all just say thank you very much to everyone who participated. Unada, Thierry, Bas, all of the audience. I think it was really interesting to get the bigger picture. We have the study and the models that show what is needed and what can be achieved. We see also that there is an investment framework and we need to change this a little bit to get there. We see that some countries are already on the move, so Europe has to also go this way. The study comes very timely because in the next 2 months, I guess we will have a decision on the climate target in Europe. So to actually have, again, the message, a higher target can be also beneficial for more jobs and for more growth. I think it's good because also the Commission says all the time, well, this is our also our growth package. So I don't understand why they do not want more of this. I mean, as a Green, I can understand that sometimes growth is a bit critical, but from the Commission's position, I don't understand it. And so I will use this study in the future, and I hope some of you in the audience will also use it when you discuss things, and maybe also when you discuss with other players to say, look, there is really good arguments to actually go for more climate protection. It's good for our climate and it's good for the economy and good for jobs. So there's basically, well, why not doing it? Now we have 7 minutes more than we wanted. So thank you all for joining, and enjoy your afternoon, maybe your lunch, and hopefully see you again on the climate calls. Bye-bye.